built up. This is a 5-person team that's built this with,
Yep.
more than 30 LLM models. Anyway.
Alan, you're going to introduce this tech investing deep dive every time, because that was a perfect segue to what we're about to talk about.
Thanks.
So I asked to have some brief perspectives on different ways to invest in tech. So Rafiq Ahmed from Chicago, Diplo Ventures, was with us on the West Coast. I think he's sort of like I was looking at Jennifer Garner from Denison doing improv. Like, I could give you a subject and I think you could just handle it, Rafiq.
Yeah, just don't ask me to talk about AI and manufacturing and
Well, that's what you're about to
minutes.
talk about. That's what I want you to talk about. Then we have Julia, also from Chicago. Chicago is being overrepresented today. Scaling health tech, and she's been part of our community for a very long time. And then Nelson Stacks is on his third tech transfer out of Harvard. So that's another thing. I think the guys from like Taylor Bench from Summit Venture Labs, that's their model. And then Jonathan, we didn't really have a chance. I know I came up with a headline that you might disagree with, but you're in the Beltway and you do leverage distilled intelligence. So I'm going to let Rafiq go, if it's okay. I know I'm going to lose some people, so let go Rafiq, Jonathan, and then I'll let Julia or Nelson go third and fourth. And then if anybody wants to focus on the tax, that we're talking about the tax bills, that's tomorrow at 10:30. We're getting that deep dive for next week. So, Rafiq, over to you.
Yeah, hey everyone, Rafiq Ahmed, Diplo Ventures. Sorry?
You have the wrong screen up.
I have the wrong screen up. Okay.
Actually, I have my screen up, so let me stop sharing.
Okay. Can everyone see this?
There you go. Ooh, that looks like Chicago.
It looks like Chicago. Okay. So just a quick intro, Rafiq Ahmed, Diplo Ventures. So we are early stage deep tech investors here in the heartland, middle of the country. We focus on hard tech, but we love software, who doesn't, and are looking at applications of AI where it makes sense. But we lead with hard tech. We're not afraid of it. Ex-Motorola Google team. And honestly, we love the valuations that we find outside the Bay Area, New York, Boston, and so we lean into it. Where's Jack? He was talking about
The
Columbus,
Midwest.
yeah, in Ohio being
Cincinnati.
the ecosystem that he's certainly investing in. And so it's like that here. Lots of interesting ecosystems around the country, lots of innovation. So anyway, thank you for having me, Mark. And so we're going to talk a little bit about sort of the Midwest mismatch, why you should be looking between the coasts if you're not already. So first of all, I guess the last couple of years, the deep I think the screen's working now. Okay.
Yep.
Yeah. So the deep malaise in venture, everyone coming out of it, thinking that the first quarter or the first half was going to be, good tailwinds. We had other things like tariffs, et cetera, going on, but these numbers aren't great. Market moving back to coast is not what I want to hear. Chicago, I think, got up to about 6 or 7 billion in annual VC activity before the big meltdown. So the first quarter number here of 0.6 billion, 74 deals, isn't something I'm going to be super excited by, but I think we're probably coming out of the bottom of that, and the second half should be better. I mean, compare that to Bay Area, Boston, New York, obviously are well in the lead. Seattle, where we were a couple of weeks ago, coming in strong at 2.1 billion. So the coasts get most of the attention. But look at the number of unicorns that are happening. Obviously, the Bay Area blows that away. 125 plus is in red. But if you look at the rest of the country, there is unicorn activity. If you look at the center of the country, going all the way down to Texas, going into Florida, going through the Midwest, there's a lot of activity here, which means there's untapped potential, and that's what we look for. But the other thing too about investing in tech is we're not just looking for unicorns. I think there tends to be this chasing unicorns and where can you produce them the fastest. There is a case to be made for maybe more moderate returns, M&A activity being the exit path, and that's also okay.
Well,
So if you
well,
look
maybe high returns, but shorter duration. We don't have to wait for the unicorn moment. Is that what you're saying, or you think we should accept moderate returns in the Midwest?
I think sometimes you have to accept moderate returns. There's only so many unicorns to go around, right? I mean, so we look for solid companies and we look for exit potentials out of those. I mean, I have a unicorn in my angel portfolio, fantastic, but do I expect one in my fund portfolio? Not necessarily. So that's not sort of the gating factor, perhaps.
Yeah.
So what I'm calling Midwest arbitrage, some might call the mismatch. If you look at the percentage of US VC, 3.8%, but we have a 65% advantage over West Coast valuations. And that is a huge, huge differential. So you may or may not have heard some of these things, but if you look at great universities, if you look at talent, if you look at some of the work going on in new tech areas, the Midwest is not lagging. Yes, we went through Berkeley, we went to Stanford, we talked about the number of patents coming out of there a couple of weeks ago when we were on the West Coast, but Chicago has number 2 and number 3 biz schools in the country, in Booth and Kellogg. We have 2 national labs here. We have quantum leading. Denver is another area where quantum is leading. If you're looking at nuclear, if you're looking at clean tech, so all these things are super interesting out here. In
Rafiq,
terms of
just a few more minutes.
yeah. In terms of an indicator of unicorns, maybe, or at least companies that are going to scale well, 100 million plus companies founded. So this is an interesting chart. So pull that out. Heydays were back in 2014 and 15. This is the year of the company getting founded. So if you look at the last few years, 2023, we already have $100 million company being founded. So that, again, may not be amazing if it's a software only situation, but in the Midwest, I think that's a very decent sort of track record for Chicago. And then finally, we have further macro tailwinds. Can't deny the fact that manufacturing is coming back and reshoring. PMI numbers this morning were pretty solid. The reality is, of course, you can't bring manufacturing back that quickly. But in terms of what we're doing at DiPaolo, this is a little bit of a snapshot into our world. So it's not tech broadly, but it's tech with a core in hardware. And it's a lot of different things around food and ag and clean energy, consumer devices, med tech. So there's a lot here. Welcome you guys to come out, see Chicago. We have Tech Week coming up, July 23rd. Aspen Institute is going to do their Climate Week as well. We're involved with that. Hit me up if you want to find out more info.
And as many of you know, and if you don't, we did the Midwest tour after COVID. We went Chicago, Detroit, Ann Arbor,
Yeah,
Cincinnati, Columbus, Cleveland. We almost went to Chicago, or sorry, Pittsburgh and Buffalo. I know Buffalo's. I think the Midwest starts in Buffalo.
you
Excuse
got to
me,
come back. Yeah.
Rafiq, will we be able to have access to this presentation?
Yes, absolutely. I can. I think it's going to be part of Mark's. Mark,
But
I'll-
you can
Oh, yeah, you are recording.
and also you can put your contact info. I
Yeah,
almost
just
feel
shoot me a
like we
text.
should go to you, Julia, because he's teed you up with Chicago, but you're not just doing Chicago, neither are you, Rafiq. But I'm worried that we're going to lose Jonathan, so I'm going to let him go to the 4. And you may not have slides, Jonathan, but just, if you could give us some insights into how you see the tech world today.
Sure. I do have a few slides, if that's okay, Mark.
Okay. No
Thank you for
pitching.
the-
Go ahead.
No. Thank you for the opportunity, everyone. Jonathan Pirelli with 45 Ventures Fund 2. Very simply, I agree with Rafiq. There's a lot of great companies at great valuations outside of Silicon Valley. We are based in DC with an office in New York and one in LA. I'm just going to cruise through. Forgive me for sliding here. Real quick results on Fund 1 for us. We had one company at a $500 million exit valuation that was called IntraHive. Hinge was acquired by Match. We're the first investor in Hinge at under million valuation. That's a multi-billion-dollar property now. And IDMe, we still hold shares in. So at a 2.53x DPI, we did really well with Fund One, and we still have, I think, room to get to 5x with IDMe. They're talking about going public, and then some other acquisitions here, Flexi by Pinterest. All these companies we found through a pitch event that we host ourselves. We've hosted it twice before, 500, then 1,500 attendees in DC. We're now hosting it October 14th, 15th, 16th at a Lansdowne Resort. Loudoun County, Virginia is the wealthiest county in the country. They're co-hosting the event with us. It's Data Center Alley, tons of energy companies, defense, cyber, quantum, and we're excited about this event. So we have a discount code. I think it's 361 MARK. Mark, I'll send that to you for $200 off the ticket.
That's interesting. Okay.
You know,
361
I hope you like that.
Yeah.
It's an event that includes, I think it's 9 meals over 2.5 days. We have $1 million pitch event paired with a Davos for startups. So think about industry-specific verticals. So we'll have hardware, cyber, software, cyber, VCs, angels, and founders and operators in those circles playing pickleball and cornhole against each other. We're going to have a ton of fun. We already have, I think, almost 200
We're not
people.
competitive, Jonathan. We don't play pickleball. No. Wait until you see our crowd come and join you.
There's golf and tennis as well. So we bought out the whole resort. We're going big because we wanted people to be able to relax and get to know each other. Mostly investors getting to know investors. That's how deals are done, as we all know. And a couple of just real quick, Mark, stats, team. I'm going to go straight to our current funds. So our portfolio.
Well, maybe just if you could, focus on like a theme. What's a theme that you think we should be thinking about today?
Well, for our region, defense, cyber, and energy are massive. There are companies coming out of the woodwork, and a lot of them are founders coming from large companies, finding a niche problem and solving it. And we're seeing valuations under the typical $20 million series seed. So we're excited in the same way Rafiq is for valuations that are outside of Silicon Valley. We always have had those. And the themes that we also see are human health, which we've got 2 of our 4 current first deals in, and future of work. AI is changing everything fundamentally, and we believe that vertical AI platforms are things we'll invest in.
All right, you've just set up Julia.
Perfect.
Julia,
good luck, Julia. Thank you.
Health. What did you call it, Jonathan? Human health. Human health. And what is that? How do you define that?
We define it as anything for currently med tech devices and software. So we have Sapphire Neuroscience is a device that helps women through chronic pain related to perimenopause, menopause, endometriosis, PMS. Different health platform company that is first customers Goldman Sachs, where they have a performance lab set up on site for blood tests, MRIs, etc. So we run the game. Outside of biotech.
Okay. Well,
Jonathan, I'd love to chat with you later about some of the health stuff you're doing.
Yes, Rafiq, love to. Thank you.
I'd love to see all 4 of you co-invest on something. Okay, so Julia, does any of that resonate?
Very much so. Thank you for all those great introductions. It sounds like we have amazing areas where we can collaborate.
So you take over from here, Julia.
Okay, sounds good. I have a few slides. I'd like to open your mind today on how to generate outsized returns in healthcare software. My name is Julia Monfrini Pive. I've been investing in healthcare for 17 years now. I started almost like an AA meeting. I invested $1 billion in the space, including in private equity, and now taking that experience, knowledge, expertise, and networks to early stage healthcare tech. Let me explain to you why we can drive outsized returns. One, healthcare is a massive part of the economy, almost a fifth. We all know it. It's $4.5 trillion. It's a very complex space to invest into. I've been doing this for 15 years in the US, and I'm still a humble tourist given the complexity it has. Therefore, specialized managers tend to outperform generalists by as much as 700 bips. So if you're looking for alpha, specialized people is a great way to look into. Healthcare is slow to adopt anything. It is so because patient safety is at the core, because you need to generate clinical evidence. And therefore, Bessemer Ventures actually, their data showed that it takes twice as long to get to $10 million ARR. But when the sector adopts, it's very sticky, it's very resilient. Second fact you may not know about healthcare tech investing, exits are smaller than what most people think when we talk about a $4.5 trillion industry. Most exits are between $200 and $400 million. Only 5% of the exit by counts get over $1 billion. So actually, small is beautiful. How do we make money in that space? We make money by coming in early. On the left side, you see the chart of a traditional venture fund based upon the power law. The power law doesn't work well in healthcare for the two facts I just gave. On the right, you see our performance. We came in early, we did a more concentrated portfolio, we provided more support, we exited once the companies got the sweet spot, so we already have an exit. What it means in healthcare tech, you actually need to take a private equity, growth equity approach in order to make money. Healthcare is an amazing place to invest in. I've been doing this through cycles. Even now, it's not recession proof, but it is recession resistant. People get hurt, continue to go to the hospitals. Hospitals have no choice but implementing technology these days, software, to 1, drive revenues, 2, cut costs, 3, sometimes improve patient outcomes, but primarily the first 2. So actually the pipeline of our companies have continued to accelerate in the last 6 months, despite the chaos in the macro environment. We at Pace go where others don't look. We're based in Chicago. One, it has great advantages in terms of valuation. As Rafiq highlighted, we're also at the center of healthcare. All corporations are based here. We've done a proof of concept fund 1, which is currently outperforming top decile VC funds. That's us in short. Mark, you have a question?
You can't show performance.
I can't show performance.
In a meeting
That's
like
us. That's what we do in short. Happy to answer any questions you may have on the sector.
Okay, well, we're going to go into breakouts. There'll be one for Julia, one for Rafiq. Actually, Jonathan, you may not be able to stick around, but let's, last but definitely not least, on his third Harvard tech transfer opportunity, we have Nelson Stacks.
Thank you, Mark. It's a pleasure to hear all the other presenters. Mark and I just chatted last night, so I don't have any slides. I was just told to talk for about 3 minutes, so I'm going to make it quick. My presentation today, or discussion, is really about out-licensing. And the most important factor to consider, in my opinion, is, what is this group likely to, how are they to deal with? If it's a university or if it's a corporation. In my case, I've spun technologies out of both Harvard and MIT, and they've been absolutely fantastic. They get the model, they understand the university makes money by taking a small percentage, and they're successful if the startup is successful. So instead of asking for everything in the world up front from the startup, they really get, they become wealthy the more success that the university becomes more successful, the better the startup becomes. So they're not asking for everything up front. And so I'll give you an example of an issue where we had a problem. One of my companies, all the other companies have been successfully sold, but one of my companies, we're doing clinical trials, and Stanford is a fantastic place. Unbelievable technology has been generated from Stanford, but this is just an example that happened to us. We had negotiations in place for clinical trials, and everything was set. We're about to begin the patient trials for a particular new device, and then literally the last minute, like a week before we were going to start patients at Stanford, they call us up and they said, "Hey, we got to renegotiate." What do you mean renegotiate? We're done. I said, "Yeah, we need 300% increase in the price per patient than what we'd agreed." And we said, that's just a non-starter. We can't afford to do that. And we found another hospital. Everything went well. We successfully sold the company. But my point is, understand the group that you're going to get in bed with. And just because the deal is signed doesn't mean it's over.
Wait, Nelson, just to clarify, that last minute change came from whom?
Stanford University.
From the university itself. Okay.
Hospital system within Stanford. We were going to do about 300 patients from Stanford. And they just said, "Hey, by the way, we're going to need if it was 7,000, we're going to need 21,000 per patient." Like, what? That's a massive increase. And so we skipped Stanford and went to some surrounding hospitals on the West Coast, and everything worked out great. So, the other factor to consider to be truly successful is understanding how the technology that you're going to license might be used. If it's a molecule, you're a lot more restricted. If it's a device or something that can be put into a device, then you have a lot more flexibility in how you can structure that deal with the university, the corporation. So if it's a device, you might think about razor blade model if that works. And if so, how much of the university is going to get? Are they going to get purely the revenue? Is it going to be the revenue on the razor blade or the razor? In my case, our company now, we structured everything on the razor because we'll sell less razors than razor blades. I don't want to give Harvard, it's fair, Harvard's going to get money, but I'm not going to commission them on every razor blade if the foundation of the technology really was for the razor.
Do you mind explaining what do they receive on the razor?
Yeah, so they get a small revenue source, single digit percentage of the sale price. But even that, let me now break that down. So if I sell the razor for $10 and I say I'm going to give you 5%, 6%, 3% of every razor, okay, great.
Mm-hmm.
But this is the other point I want people to understand is you can also structure the revenue share from the razor itself. So the razor might cost $10,
Mm-hmm.
but I only attribute the portion that I licensed from Harvard to a percentage of the $10. So I'm not giving them 5% of the $10. I'm saying, well, of the razor I sell, the technology in the razor is $3. The software that goes into the razor is $4. And then some additional work is another $3. So I'm only going to give you 5% of the $3 of the $10 for every sale. So that's what I want to get across. It's a lot of flexibility that you have, and you really have to be.
Got it. How many universities have you dealt with? Have they all been?
I was a venture capitalist for a long time with a Kauffman Fellow before I went into operating. So I've dealt with many.
You did Stanford, Harvard, any other universities?
MIT, University of Chicago. So I've structured.
Who's your favorite?
MIT is hands down the best. They just get it. They're just easy to work with. They're not trying to screw the entrepreneur. They get like, we're going to be better off by 10 companies spinning out of here than trying to suck all the revenue out of one.
Rob Colorina's got a question. Is it for Nelson, Rob?
It's actually for a couple of them. With respect to what was going on the fundraising side, all of you guys presented great stories. How come it's that difficult, and how are you guys going to sort of navigate sort of the those either difficult or slow waters on the fundraise?
I'll let everyone hit the navigation, but what I heard this week 3 times, I'll invest in venture once I get my money back, back in those vintages. So it's an opportunity and a crisis, that I think someone was saying earlier. But I'll let the speakers maybe we'll do this question and then we'll go breakouts. How are each of you navigating today in this difficult venture environment? Maybe whoever wants to go first. Julia wants to go first.
I can start. I can just say, raising money is my wife always says to me, she's like, "Aren't you done?" I mean, it's just crazy. Never said to me, "Now is a great time to raise money," unless you do an AI, some kind of startup. So I say, this is what I do. This is what I get. So the key right now, I believe, is you have to de-risk as much as possible. People are willing to take, investors are willing to take on risk if the exit profile is there. But even so, they want as little risk as possible. So for the entrepreneur, keep it in the university as long as you can. Try to have as many proof points, positive points as possible. And if you can have some kind of, external validation on either technology, sales, something that, as they say, the old Harvard article was, will the dogs buy the dog food? That the dogs are in fact willing to buy this dog food. It's not just a pipe dream. It has legs to it. But I'll let others speak as well.
A couple of things. I think in the current environment, someone made the point earlier, there is actually a lot of capital sitting on the sideline. There is just a liquidity issue and a lack of appetite for increased risk in venture when credit can pay that much. So 2 things we've done. One is we've led with our performance, which again is top decile, et cetera, et cetera. 2, we've welcomed more smaller checks that will increase commitments over time, but from investors we want to have in the long run, even if they start smaller than we would love them to be. Also, we built a relationship with Strata Trust that actually handles IRA direct investments, and we've closed on actually millions of dollars that way.
Yep. Actually, I'm seeing JP. JP Keating, how are you navigating this? And then we'll go on to the others.
Yeah, still here. So first of all, the emerging managers in 2019 through 22 spent a lot of money at too high a valuation. We all know that. That was the problem. Past performance is actually an indicator of future success. I know we hear it all the time that it shouldn't be, but what we believe is getting in early, getting in at the right valuations, and being a leader. This is why we host our event. That's how we see our way around it. We host our own event, we bring it together, the ecosystem, and together we find the great deals. It worked for us in the past twice. We believe it'll work this time. That's how we see ourselves working around it and working through it. But the reality is, it's a slog. If you're raising a fund, instead of talking to 300 folks, you've got to talk to 900. That's the reality these days.
So I hear you on that. What we're trying to do is, this is 2025. We're in the age of AI. And we're trying, at least as 361, and we're in a beta, but it's if you can go. So Rob, you asked the question. Rob is affiliated with a group that knows manufacturing. They're somewhat global. If you can find exactly what that investor lines up with, the more you understand that your investor, and I used to say with Facebook and LinkedIn, there's no excuse. Now we have AI. Know your investors and be ready and target them and be ready for those discussions. I don't know who Rafiq or anyone else?
Mark, this is JD.
Oh, yes,
you had asked me a quick question. I just, it's consistent with just about everybody else. You get up and you smile and dial. That's pretty much all there is to it at this point. It's finding the right investors that believe in the particular thesis. Ours is all around defense logistics, supply chain, dual use, commercial, supply chain logistics, mobility. If you want to do pure AI, we ain't for you. We have a ton of AI associated with everything that we're going for, but we're not a generalist. And if people are looking for specialists, that's who we want to work with, and people that believe in the mission. And we've got a mix of just about everybody in here, and it was Julia had mentioned the IRA investments. We have a lot of those folks, that are executive types that believe in the mission, and we're able to raise from different things. But we're also building micro funds. I'm not going to try and build a massive fund at this point. We've got so many opportunities. If we can fund them fast, we can do deals and just keep building micro funds as we go.
I think that's a good point. I think it's not perfect, but it's doing some of these deal specific SPVs is a way is one navigation. Rafiq, you want to hit it?
My 2 cents, I guess, just a parting thought is, there used to be a time when venture capital was about taking big bets and having the balls to be in this space. And I feel like we've come into a time where we're having to appease just about everybody across the investing landscape. And it's not about patience, and it's not about letting things take the time that it takes to bake. Some of this tech you can't do in 3-4 year cycles. It's just not meant to be. So I think it's dysfunctional. I think something's broken. Yeah, we can do rolling funds and SPVs and quick closes and move to the next numerical number. So, but yeah, hopefully there's a better day coming, and some of the early I guess sentiment around why venture capital can make a return, but I'm probably being too optimistic.
So I wanted to break outs, but I see Andy and Carolina. Andy, you spoke earlier. Carolina, do you want to speak first, if you don't mind?
Hi there. Yeah, so just quickly, I think Rafiq touched on it very briefly, but so we saw Lightspeed recently and other Silicon Valley VC funds transforming into registered investment advisors. And obviously there's new forms, the VC is evolving. I was wondering if your deployment model is still 10 years, or are you thinking about other forms as well?
Was that a question to me? Our deployment model for the second fund is 10 years, but we've done transitional SPVs that act as mini pools, if you will, with more than one asset. We're kind of too small to think about too many things like an RIA. Bigger platforms would be better suited to those types of things. Yeah,
Yeah.
is there such a thing as a 5-year, 7-year? I mean, in Europe, you do have 7 and 8-year terms, but it's not really venture assets as much as maybe renewable projects, things like that. It's really difficult to get away from a 10-year term. I mean, if somebody's got great ideas around that, I'd love to chat.
Well, we did have a secondaries panel, which you should all watch that from Menlo Park was our second annual. We'll do another secondaries. But again, Andy, I'm going to pause on you again. Tammy's new. Bring her in.
Hello, quick question. So one of my multiple hats is I work at LOHAS, and we help, and this isn't about LOHAS, this is genuinely about my question. But we help a lot of our clients, our funds and fund of funds and founders that are doing raises. A lot of them are women-led or working on community development. And what we help them do is bring in, and we're not the only ones, Impact Assets and others, but bringing in nonprofit philanthropic capital into the capital stack. So going to investors to go back to their DAFs and get them to de-risk that way. So I don't know if that type of strategy has moved into the AI space. I feel like it's a natural to do it, at least in the health and wellness part, but I didn't know if any of you are deploying strategies of going in the funds that you're doing to your investors and bringing in some of that either recoverable grants or donor advised fund capital.
Or maybe that's a question for anybody with a DAF. Are you doing any of that?
Yeah.
Anyone on this call wants to speak up? Because this is not just about the panelists, it's about us all talking.
My DAF is too small, so not yet, but maybe one day.
Anyone else?
No, Mark, we're in the same boat. I mean, we're relatively too small. I mean, it's possible with some really small foundations out there that we know, but it's typically too risky for what they
Well,
want.
I think the point that making it for you, Tammy, is that they're sort of mission or values aligned investing opportunities, and small is not the issue. They can do whatever sizes.
They can do 5,000. It doesn't. I mean, that's the
Yeah.
flexibility of DAFs. Is you decide, whoever's doing the raise decides the minimums, and it's
so
money they
Rafiq-
wrote off anyway.
So Rafiq answered it from the perspective of having his own DAF, but from their DAFs can be rather large or small, all different kinds. Here's another person. I like new voices. So Glenn, are you going to talk about DAFs or are you going to talk about real estate? What are you going to talk about, Glenn?
No, I was going to go back to VC if that's okay.
Yeah.
I just had a question for the VC savvy folks on the phone. Having just exited back in 2023 from a VC in the biotech sector with a 1.1 billion exit, are you starting to see that a lot of the assets that are in these VC firms as they come to the end of their funds with maybe some of the lack of returns that they didn't expect? Are you seeing some of the assets that still have legs moving into secondary funds or something along that lines, continuation vehicles of some sort?
Anyone?
So yes, CVs have been the name of the game for the last year. It kept law firms and peers busy. I think I wish I actually had some liquidity to go buy some of those assets for pennies on the dollar, because many have good business models, commercial traction, strong teams, but just bad balance sheet. Valuations were too high 3 years ago. You can never exit it at that level. So might as well offer an opportunity and rewrite the
And
upside.
some of them just need more time.
That's true. Yes.
Yeah, particularly the deep tech bits. All right, Andy, go.
Thank you.
Andy, you're on mute.
My comment was right there anyway, was that first is that healthcare has not had the valuation hockey stick over the last decade that you've seen in other sectors. Two, that and I did my first 25 years ago, and my recent co-invest with a biotech ran off 2 years ago. The underlying investments at least are proven themselves in much more short order than typical empire building Silicon Valley type investments that take decades or more. And so healthcare, really, the argument is that, one, you can have these shorter time frames, and yeah, maybe you need to actually exit a little longer, but the proof of concept and business development and all of that can be much sooner. The biotech fund only did phase 2. Doesn't take more than 3 years. So they buy phase 1, just do phase 2, live, die, sell it, whatever. So we did it in less than 5 years. So the argument to people investing in VC is, 1, valuations were not elevated. 2 is the time frame should be shorter to measure success, however you measure it. And so you shouldn't look at it in the same view. And I haven't seen continuation funds in healthcare. I've seen them in a lot. My inbox is full of them in other places.
Thank you. Appreciate that.
Any other comments?
Mark,
Yeah.
I just wanted to add on DAFs. I'm seeing some interesting things happening where, I think people are trying to organize DAF funds to come into venture and PE at scale. So, not individual DAFs, but foundation DAFs, et cetera. We have a fund of funds here in Chicago who are kind of split their strategy between raising capital from institutional LPs, but then the other half of it is from DAF. So there are some exciting things happening in DAF for sure.
Right.
Hey, Mark, I've got a report that I'll share with you, and you could share it with the community. Bobby Franklin from the NVCA spoke at Invest Midwest last month, May. And he had a really good presentation. He sort of had a state of the US VC market with a lot of bullet points. So it was publicly released. So I'll shoot it to you, and if you want to send it out to the community, it answers a lot of questions here and gives a bunch of statistics that they pull from. A lot of it's from PitchBook and their own research, but it's pretty interesting, and it's got a focus on the Midwest angle as well. So it might be beneficial to folks. So I'll email it to you, and you can shoot it off.
Sounds good. I saw Spencer Walker. I saw your note just on the whole tech transfer. Do you want to just share a bit like what you guys are doing on that angle?
Yeah, I was just thinking about, the schools that do a lot of spin outs from tech transfer, they should be good at it. And I think MIT and Stanford are kind of recognized for that, but there's other schools out there that are doing, 15 or 20 startups a year with varying degrees of success. And so
can you provide that report that you guys do on schools?
Yeah.
Maybe
I'll get in there in just a minute.
And JP, you don't have to just email it to me. Just put it in the chat. Share it if you don't.
Can I put an attachment in here?
Yes.
I'll try it.
Anyone else? Perspectives? Parth, I've seen you on camera. You're in Austin. I've heard, I want to be provocative, far from be it from me. I've heard everything from, Austin is great, it's edgy, but nothing's really happening in Austin. What's happening in Austin?
Yeah, look, I think I'm a bit biased, having grown up in Austin and spent the majority.
I enjoyed our time in Austin, by the way, but
yes, it was wonderful.
I gotta get you to Newport. Are you gonna join us in Newport?
I will. I'll be in Newport on here in 2.5 weeks.
Perfect.
So look forward to seeing everyone there. Yeah, when it comes to Austin, I think that that a lot of the exciting things are happening, right? When I was growing up, really Dell, IBM, and there were a couple of others, but we're mainly the only games in town, right? And now you're seeing a lot more, even large corporations move to Austin, but there's a lot of exciting work and innovation happening, especially I would say in the technology space, right? And as a result of that, I think Austin is now on the map, so to speak. You're seeing a lot of managers, some of the VC firms we've invested with previously. Austin's kind of one of their stops now on the road show. From an LP perspective, I don't think the ecosystem is still as robust as a lot of the other larger cities, and is certainly still overshadowed by larger Texas markets, whether that be Houston or Dallas. But again, I'm biased, but I think a lot of exciting stuff is happening in Austin. And if any of you are in the area in the coming months, please let me know, reach out, and I'd be more than happy to host you, and would love to get together.
Parth, question: Do you play pickleball or cornhole?
I play it all.
Okay, so you got to join
It's
us.
it is a little too hot though in
No,
July.
but in Virginia, where Jonathan's hosting us in October, I think it's gonna be perfect weather.
I would be honored.
I was told early in my career that you make money in venture early or in secondaries. You have to come in early, or you find or you have so much money and access that you can get into the best funds where the top tiers are. Also throwing that out. Anyone else want to add? I guess we're not doing breakouts today. We're gonna have community discussion.
Mark, I just dropped that file in the chat. Sorry, it took a little bit to
Perfect.
upload.
Thank you, JP. Anyone else?
Hey, Mark, it's Rob. Just thanks for addressing my question on the uncertainty, whatever. I guess one silver lining is that if a family office or high net worth or whatever does step up, and I like Tami Kesselman's point too, that even at these the endowment and foundation side, they may not be as bureaucratic if you've got the right sponsorship. Or the other angle is if you get a certain brand in, it leads to others. So the twofold. One is that on sort of some quasi anchors, and secondly, there's advantage to the investor that, you know, hopefully if you go in during tough times, there's a relationship loyalty of coming in early and things go well. You know, there'll be obviously preemptive rights, but more just relationship benefits that the GP will recognize. I just want to throw that out to you, Mark, and see if you or one of the GPs thought similarly.
Or LPs, if anyone wants to weigh in. Thank you. Anyone? Rob Colorina just threw a softball.
It's fine. Some folks don't want to consider sort of lower valuations or what have you, but it's an interesting market dynamic right now. What I'm seeing.
Hey Rob, we met at Super Return in Miami earlier this year. Just wanted to say hi.
Good to see you again.
I think the secondary market and all of its dynamics and manifestations is an interesting, I guess, you know, since we're actually, some people are in the waiting room. I guess it's really tells us where the market is. So, because if you can buy low with this great discounts for all kinds of reasons, you have the ability to, you should do that before you go into a new fund. At least that's the mentality of some of the families. And I was seeing that coming together, and then there's the duration, end of life funds, but I think I'm just seeing a shyness, unless someone can just, they're doing more due diligence on the funds. Definitely we're seeing staff, you know, relationship building is important, domain alignment, values alignment, to Tammy's point. You got to find your some angles or edges in today's market. And definitely play, you know, even, I mean, Jonathan, you got a secondary from your original fund, right? That you got to find your ways to get access to liquidity for your LPs.
We do. We exited as much as we could in June of 2021 in Intro Hive. And
I think it's you, Jonathan. You're a little...
Yeah, it was 500.
Is it me or Jonathan?
Probably his.
Yeah, I think it's John.
All right. I'm gonna have to stop his video.
Mark, if I can jump in with just one comment. I mean, our first fund is a smaller first fund now, you know, going into a second one. The problem, I mean, I'm looking at it, trying to understand the market for secondaries, but the problem is net asset value is still not enough, right? And it's like,
Yeah.
it's too soon, and I feel like the ones that are good are going to play themselves out. But at the same time, yes, more DPI would be tremendously helpful to everybody, including to the GP.
Well,
So it's a catch-22, really.
But
Still
let
learning.
me that begs another point related question. What are people seeing in the IPO market?
We have one that is not in the fund, but in my personal portfolio that should list if they go through the process maybe next year.
But anyone active in the pre-IPO market? Anyone
Oh,
here?
not as much.
I'm looking
I think
across.
Bill sent a message, maybe related to that. Bill Deutschler.
Hmm?
Do we
Bill,
count SPACs?
Yeah,
well,
no,
you
yeah.
have to.
Thanks, Rob. No, I just dropped something in the chat. Just in general, dilution company failure rate obviously has a huge impact on DPI. And it's a really difficult, I think the current environment is really tough on portfolio companies, and that makes it, just all the more difficult. However, there have been a few funds that I've come across that have an actual process to try to do more effective portfolio management of their underlying companies. And that potentially has a huge impact on DPI. I mean, just the simple math of it, if you can take your failure rate, from 70, 80%, down to even like 60 or 50%, then, just doing the math, your DPI can expand, tremendously. But again, it's not an easy process, and I've only seen a few funds that have been able to implement that.
Hey, Bill, I think we should do a second half of the year survey 20 should kick off. We have for July 20. If we could talk about that.
Sure. That sounds good.
I know you like sailing.
Absolutely.
Anyone else? Questions, comments on the theme? Depender, how do you see today's venture market as a active angel, value adding active angel? You're on mute. Still on mute. One more still on mute. Depender, you owe us all a drink of whatever juice, punch.
Okay. I think there are a lot of opportunities, and I think it's a good time to negotiate hard at what price point you go in with them. As always, the harder to raise money, the better the opportunities, in my opinion.
Fair enough. I might be driving by your truck stop in Pennsylvania. I'm going the way to Pittsburgh tomorrow.
Are you going on 80?
I might have to go. I usually go, what is it, 76? But I have to go more north to Pittsburgh.
Well, make sure you don't run out of fuel at our truck stop, because we're the most expensive gas in Pennsylvania.
Yes, of course. Anyone else? Well, maybe that's the sign. The pause is a sign sometimes. I will
When are you back, Mark, from Pittsburgh?
on the 8th.
Okay, got it. Let's get together.
By the way,
Mark,
it's for everybody.
For
It's
Newport, Rhode Island,
really,
are you there as well on the 21st?
yeah, I'll be there.
Are you there? Are you there Monday or Tuesday?
I'll be there Monday. Not. I don't think Tuesday, but I'm definitely there to the. We arrive. We're there at 10, and then we have the 11 a.m. start like last year. But we start a little bit earlier. We want more content this year. Breakouts. It'll look like everybody. It'll look like this at the end. We should have taken the
Okay.
picture before everybody left. But this is
And
a,
Mark, you missed a
Mark,
good golf
Mark,
outing.
Mark, let me know if you need a ride up.
as much as I love you, I'm gonna drive myself.
And Mark, you missed Canoe Brook in Summit. That was really good. We're going to have another gathering in probably next couple of months.
I know.
So sorry it couldn't work with
I
your timing.
I had to pick up my daughter at school, and that didn't work with your tea time. But
Okay.
I think it is time for us to have a best ball tournament for 361. I don't know if we can do 18 holes, but I think we can get a 9-hole best ball afternoon in. So I'll be back on that one.
We have a 9-hole course.
That'll be the
reserved
first,
at
right?
Sorry, Jonathan.
We have a 9-hole course reserved on October 13th at Lansdowne, right before our event. If you'd like to play that.
It could be. And by the way, Rob, do you know where Jonathan is? His county? What's
I was following this a little bit. I think it sounds like Northern Virginia. So I'm in Virginia part of the time. So look forward to hearing more, Jonathan.
Great. We'll connect, Rob. Thank you, Mark.
But Mark, this would be the first golf tournament by you?
We had golf and a shoot and like a range, but we'd be the first. We almost did one with Stephen Burke, but yeah, it'd be the first official.
Okay. Take a look at your email. I might have something for you next week in the tri-state area. So okay.
Okay. Good to know.
Hey Mark, is the
by the way, that's a first to get an invitation from Rob Collarina a week in advance. That is a first. Sorry.
Hey Mark, is the meeting next week? Is it in person in New York or is it virtual?
Which meeting?
This one.
Oh, well, it's always virtual. The question is, do we do it Tuesday the 8th in New York because you happen to be in town?
I happen to be in town most of next week.
Are you here on the 10th?
I am here on the 10th until about 4 p.m.
We are trying to figure that out because now we have summer schedule in New York and the Hamptons and all that. So we are testing the waters to see if we do our meetup in person on the Tuesday or the Thursday. So your vote. You sound like you're neutral.
I'm good either way. It's just, yeah, I got a ton of meetings, but it's always good to meet up with more friendlies while I'm there.
Fair enough. Anyone else before we break? Again, join us in Newport. Tomorrow at 10:30. We talk about a tax update with the new legislation. That's more of a mobilization call of trying to get a really good roundtable panel for the next deep dive next week. Otherwise, we're planning out Hamptons, we're planning out London, and I don't know if Parth is still on. We're planning out Mumbai, Singapore, Riyadh, and then 2 big New York events. So if anybody, tomorrow at 10:30, we'll gather mainly about tax, but we'll talk about events in case anyone's around. Africa is 2026. At least 2 or 3 countries. We also have a LATAM event in Miami on September 12th. I don't know if Adam's on, but that's coming together. We got to get to Chicago. As much as I'm in Ohio, we got to do another Ohio event. So, and anybody wants to host a lunch in your city, if you can do a Zoom, we're going to do one in Seattle, a Seattle breakfast, lunch, New York. We're going to bring those 2 cities together. Also open to doing that.
Yeah, I'm open to doing something in Chicago. We've got some folks here.
We can do it anywhere. Winston and Strawn loves us. We love Winston. We could do it from their offices or yours for that matter.
Hey,
We're
by
in
the
a big manufacturing hub. We could be right next to the machinery.
By the way, I visited with Rafiq at the M Hub. That's great. It's a great place to visit if we have a chance.
What's it called again?
M Hub.
Oh, the
manufacturing hub.
Yeah.
Yeah, it's this great ex-Google prototyping facility that was left behind. So
Nice.
it's where a lot of the local startups start. We're one of the few VCs here.
Yeah.
Good
Of course.
ecosystem.
Great.
Great place for events. So if you're coming to Chicago, Mark, we do something. We gotta definitely get these guys involved too.
Mark, I threw a little note in there. Maybe first-ish week of October. St. Louis would be a good one. There's actually two things
What?
we can do.
You tell me where it would be a bad place to be on the first week of October. Isn't that like the best week everywhere?
It'll be nice. It'll be nice. It's like October 6th. Figure like October 6th through the 9th. We can have a longer conversation.
October 6th is there's a Seattle event. Not that I could go anywhere. Last
Well,
time I was in St. Louis, the American Idol was there in
that's
my
been a
hotel.
while.
That was a while ago.
It's been a while. Now we got
I flew over it and it was flooded in 2008.
Yep. Now we're going to be throwing an event regardless, part of that week in conjunction with the National Defense Transportation Association. So they have a huge conference.
I have a call later today with a family office who has close ties to DoD and DOT. That's
cool.
This
Hey,
is
we'd
really
love to talk to them.
Like this is being recorded. This will be, you haven't seen it yet, but this has been, this will be transcribed and put into our AI. And if someone wants to know JP, you can see JP and all of his insights. If you want an insight on St. Louis, you look to the St. Louis. We're about to like go from the outhouse to the White House on AI.
Yeah,
Really,
that's where we are.
The White House or the outhouse?
The White. I mean, we're already dealing with the White House. There's a lot going on here that most people don't know about, and we're one of the only players in town. So it's
Rafiq was talking about the Midwest advantage or arbitrage. There's certainly a St. Louis component of that.
Yeah, we've got a lot going on. You know, our thesis is squarely aligned with a massive amount of resources here. But again, we're global in nature, but we've got a lot of resources here that back up the thesis in a very strong way.
A lot of great people on this call that didn't speak. Goodbye, everybody. We'll have to connect soon, and we'll do it Tuesday, Thursday if you're in New York next week. We'll make that call in the next day or so. Let you know. And
have a good one.
Thank you, everybody.
Thanks, Mark.
Sounds great. Thanks.
Thanks, everyone. Bye.
Appreciate it.